Now we will start the chapter called reversal and retracement. Now, for example, in reversal retracement, the market is going in a bad trade. So if the bear is, the bear is moving, the price always. We learned that the price moves in waves, never directly. It doesn't go straight up, it doesn't go straight down. Now the price has gone up, now the price is coming down. So does it mean the trend has become bearish or the trend has become bullish? No. This means that a retracement is happening. But yes, if the price is coming down, has a reversal happened? Has it turned from bullish to bearish? Now, how do we understand this and why is it necessary to understand? Because if we keep making profits in buying and now the trend has turned bearish and we haven't closed our buy positions, what will happen? All our profit will turn into a loss. That's why we need to identify what a reversal is. What is retracement? Why? If there is a retracement in a bad trade, we need to make a buy entry during the retracement. If there is a reversal, we should not make a buy entry during the reversal. We need to make a sell entry. So we need to identify this change of trends. Now, retracement has some characteristics. And what is the characteristic? It is a short-term price correction. It will not be visible on the long-term indicators of the long-term trend. For example, the 300 moving average will be bad. Your higher time frame indicators, it will be above the daily rack. The MACD crossover will be bad. So, for example, you can identify from these that the trend is, if it is bad, then the price coming down, what is it? Short-term price retracement. And another thing to keep in mind, in retracement, the fundamentals of the price never change. For example, the fundamentals are that Europe's economy is bad and the US economy is good, so now the price retraced. So if Europe's economy is still bad, it's future expectation. The price that is coming is bad. The retracement has come in the dollar. The dollar is weakening. It is just a temporary retracement because the fundamentals are the same. Alright. And what is the biggest sign of retracement that we learned from Fibonacci? It will be useful here as it will expect the Fibonacci level. Whenever in retracement the price starts going below the Fibonacci level 6, it indicates that this price is not a collection. A reversal can happen, so we have to keep an eye on the Fibonacci level, especially when it crosses. So we have to be very careful with that as it may go against. Now, what is a reversal? A reversal is an overall change in the direction of the trade. Now, how does it identify this in long-term price movement? The long-term indicators, the higher time frame indicators will indicate a change to you. And what will happen in this? There will be a fundamental change or a fundamental future. The fundamental expectation will change, okay? Because current fundamentals also matter. But future expectations matter more. So if the trader's expectation was that Europe's situation would remain bad, and suddenly news come that there has been a reconciliation with Russia, what will happen is that Europe's situation hasn't improved, just a reconciliation has occurred. As a result of the reconciliation, the future looks promising. So Europe will rise in the future and will even start to rise. And the point is that the market sentiment changes. So now to identify retracement, there is the Fibonacci level and you have to keep an eye on it by joining it with support and resistance. As discussed, you can look at that. And secondly, you can also draw a trend line on it. You can also use pivot points on this because when your support is there, if your pivot point breaks, meaning it's a reversal trend. If it breaks, meaning it's a reversal, you understand the point. So you need to keep this in mind. We also discussed how to identify the business, whether the Fibonacci breaks or the pivot point breaks or the trend line breaks, it's a reversal. So we need to keep an eye on the market sentiment. We need to keep an eye on indicator readings and volume. So now what we will discuss is how to protect our profit after discussing retracement and reversal. Point number 1 is that you will use a trailing stop loss. What is a trailing stop loss? For example, what did you give? We have discussed before that if the price goes up by 10 points or type, then my stop loss automatically comes to the entry. And if the price goes up by 100 pips, then my stop loss will move 10 pips behind the price. If the price stops, it will automatically shift like this. This has been discussed before. So what do you have to do? If there is a reversal, you see the indicator, you get the indication, then you have taken the losses. You have to follow risk management, and always when you get the indication of a future reversal, you have to close the trade.